Have you ever wondered how investors profit when a stock price falls? Let's break down the mechanics of a short sale. In finance, to short a stock is to bet that its value will decrease over time. The risk profile is different here. Because a stock price can rise without a ceiling, your potential losses are technically unlimited. The process involves borrowing shares, selling them immediately, and hopping to buy them back later at a lower price to return to the lender. While long positions rely on growth, short positions are essentially a bet against the company's current valuation. When the stock price drops, the short seller gains the difference. If the price goes up, the seller must pay more to cover their position. Most retail investors use shorting sparingly, if at all, because the complexity and risk are significantly higher than buying and holding stocks. Always do your own research before using advanced strategies. Thanks for watching, and remember to subscribe for more finance basics.